Excellent. Okay, let me just make sure I have everything set up on my side here. Okay. Okay, great. Well, welcome everybody, and thank you. It's great to be back with you here. Thanks for taking time on a Saturday. I wanted to talk to you a bit about today, a bit about retirement strategies. This is something that I always find very interesting. That you know, so many people try to take control of their trading, whether they're trading on a 5-minute chart, a 15-minute, on a daily, etc. But when it comes to retirement strategies and managing their retirement account, oftentimes they leave that to someone else, or they put that in someone else's hands, thinking that it's way too difficult for them to do themselves, or way too complicated. And actually, this is exactly why I wanted to do this. It is much easier than you think, and that's what I'm going to share with you today. My name is Vince Vora. I'm the head trader here at Trading Wins. I have been trading for over 30 years now. It's incredible. It's been that long, but it's been a fun ride. These are just some of the trades we've highlighted for our members. We'll go through more of that as we go through the presentation, but we've been developing our own strategies and systems over the years, and they're now being used by many traders such as yourself, as well as many money managers and hedge fund managers. Before we get deep into this, I do want to remind you that trading can be risky, so please don't trade with your own money until you're completely comfortable with the system you are using. I do this at every presentation. There's always one poll question I like to add. I'm just curious, how many of you have actually seen me present at a webinar such as this, or an event before? Please take a few seconds just to type in yes or no. I'm just going to grab a quick sip of my water, and I'll be right back with you. Excellent. Thank you so much, everybody. Really appreciate it. So in today's presentation, I'm going to start off talking a bit about the myths and the truths of financial planning, and then talk a bit about the impact of management fees. This is something that has been overlooked by many, or most are just not aware of the impact that this can have, and I really want to highlight that for you. And then I'm going to talk about three major areas. One is the art of perfecting timing. This is something that is really crucial for financial planning and for retirement planning, but it's so much easier than you might think it is. There's one simple indicator that you can use that will really tell you the direction of any market, let alone stocks. And I'm going to talk more about that as we go through it. Secondly, seasonality. This is another area that I think has been overlooked by many, but it can be extremely useful, and you're going to want to have a pen and a paper around when I get to this section. I've got a few gems for you I'm going to share with you. Overall, the presentation today, I'm going to start with what we would call classroom type material. I'll highlight some of the key areas of retirement planning, but then we're going to switch to my charts and talk more about how to actually trade for your retirement account. And that's where I'm going to share some pretty great, I would say, trade ideas with you by the end of this session. I hope you enjoy it. Also, a fresh look at diversification. This is something that, you know, has been kind of stale, I think, over the years, or has become stale, something that many people believe is way too difficult for them to handle. It's actually quite simple, and I'll show you how to do that. As always, time permitting, we'll try to get to as many of your questions as we can. So, you know, what are most people taught about retirement planning? Well, one of the things you hear most is start as early as possible, and you know that's great if you can. Unfortunately, most of us don't have that luxury, but there are certainly ways for you to make up time once you are ready to start managing your own retirement account. So yes, if you have that luxury, by all means, start as early as you can, but don't be too worried about it if you haven't been able to do that. Another thing you hear quite often is pay yourself first, and it's great, again, if you have that luxury. You know, when you're working and you're earning a steady pay, one of the things you can do, one of the easiest things you can do to save for retirement, is to pay yourself first, meaning take, 10, 15% if you can off your paycheck and put it into a separate account right off the bat before you do anything with the rest of that money. Obviously, there's bills to pay and so on, but if you can take that 10% off the top and put it in an account, it'll really help you build that retirement account. Now, the key, as always, will be what you do with that 10%, and that's what this actual webinar is about. I'll show you as we go through this, but that is very key. The other is about debts, and especially your mortgage for those of you that have one. There's a huge thing out there about people paying off their debts, and for me it was passed on from my parents, instilled in me at a very early age that the thing I should do the most is, or work towards, is to quickly pay off those debts, especially your mortgage. You don't want to owe anything on your house. You want to have it paid off as quickly as possible. Well, once I actually graduated and got into this industry, I quickly realized that really the last thing I want to do is pay down my mortgage quickly. Especially at today's rates, where they're still extremely low. Whenever you can borrow money at a low rate and put it to work somewhere else and get a much bigger return, it's well worth doing. And I would do that any day, all day, over and over again. So the last thing I'm in a hurry to do is pay off any sort of low rate debt. Now, as I mentioned earlier, when it comes to retirement planning, many people think, oh, better left to the professionals. It's a little too complicated. I'll hand my money over to someone else. Here at Trading Winds, we have many clients who are actual financial planners and money managers, and they're great. I've had the pleasure of meeting many of them in person, and a lot of them are not only great people, but great planners as well. The good ones, though, are the ones that actively manage your account. The ones you want to stay away from are the ones that put together a so-called diversified portfolio of mutual funds for you and then throw that file in a drawer and never look at it again. You're taking an enormous risk by doing that. No matter how diversified they tell you that your account is, you're taking enormous risk, and I'll show you why when we get to the charts in just a few minutes. So how should you do this? Well, obviously you start when you can. Obviously as early as possible would be ideal, but you start when you can, when it's comfortable for you and you have those excess funds. As I said, there are ways to catch up if you start late. And remember, no one's going to care more about your money than you will. So the amount of care and effort you put into this will really pay off. As I show you, as we go through this, you're going to realize that it's not going to take you any more than 15 to maybe 30 minutes a week to really manage this effectively for yourself. So it's not a daunting task when you know where to start and what exactly to do, and that's what I'm here to show you. Also, you don't need to focus on all markets and trade everything and understand exactly what's going on with the Fed or the dollar or crude. It's a matter of focusing on an area that you understand and that you're comfortable with, and over time you get more and more comfortable with different areas of the market, and you can expand your horizon and start learning different areas of it. But when you're starting off, just focus on what you know. You can still manage your money effectively. And remember, there is that balance between debt and savings. What it comes down to, as I mentioned earlier, is good debt versus bad debt. So an example of bad debt would be a credit card that you're paying 18% on. That's bad debt. That's the kind of debt you want to pay off as quickly as possible. And if we have time, I can share a couple of strategies on how you can knock those down quickly as well. Good debt is like a very low rate mortgage, for example. You can borrow against your home at a very low rate, put that money to work somewhere else where it actually earns you a higher rate, and on a net basis, you're moving forward and moving ahead, and that's really the balance here between debt and savings. So when it comes to planning for retirement, a lot of times you hear about discretionary spending, and this is an area where most people lack the discipline. And First of all, I should ask, does everyone know what I mean by discretionary spending? Discretionary spending is something that you may want to buy but don't necessarily need to buy. Okay, the nice to haves, but not the necessities in life. So, for example, Starbucks. We, we always joke around here about Starbucks and the price we pay for a cup of coffee, but if you're enjoying that frappuccino every day and spending $5 a day there, every once in a while you could do without and put those $5 towards your retirement account. Here's the key, though. Here's the way you want to do this, whether it's a cup of coffee or anything else. What most people do is they'll save that money. They'll make that sacrifice. They'll take that money they saved and leave it in their checking account or their savings account. But as soon as the next repair comes up, if their car breaks down or their air conditioning breaks and so on, they'll have to take that money, dip into that account, and pay that off. Where if you take that money and you deposit directly into an investment account that's going to go towards the next purchase of shares, for example, then it's out of sight, out of mind, and you will be surprised at how quickly that will build up. The key here also, before I move on to the next point, is not to wait till you build up a big sum of money to invest in. In other words, if you're putting it in your investment account and you're trading something that costs $80 a share, and you identify that company, you want to buy it, rather than waiting till you have $8,000 to be able to afford a 100-share lot, as soon as you build up $80, buy a share, and you'll be amazed at over time how quickly that can add up. When it comes to paying for those unexpected repairs, what you really want to have is a 3-month emergency fund. Now, all of you, I'm sure, know or should know what your fixed monthly costs are, exactly what you need to cover those costs every month. And once you build up a reserve of 3 months, that's enough. That's usually enough. So you have a separate account, you build up 3 months of those expected expenses every month, and once you have that, that's fine. Anything over and above that can then again move into your investment account. Okay. And the other thing that I found when I was managing money for people is what I heard a lot from them, especially couples with kids. They not only wanted to plan for retirement and make sure they had enough money to last them through retirement, but they wanted to leave a big chunk of money for their kids. They wanted to make sure that when they were no longer around, their kids were taken care of. And that was always the difficult part. How can you build up an account large enough to do that? To retire at a decent age where you can enjoy it, but you're going to need to fund your retirement for decades, hopefully, and then still be able to leave a chunk of savings for your kids. Well, one of the things I used to advise my clients is to take out a life insurance policy, and that way you can leave that insurance policy for the kids. In other words, they're the beneficiaries of it. So when it's time for you to move on, that's their chunk of money. But in the meantime, everything you've saved and worked very hard for your whole life, you can enjoy during retirement. In many cases, for those of you who have kids that are already adults and may already be out in the workforce, that insurance policy that may cost $60, $80 a month, have them pay for it, or ask them to pay for it. For them, it's an investment. Eventually, they will get that payoff. As morbid as this may sound, it's just practical, and it makes a lot of sense and takes a lot of stress off you and gives them some kind of security in the future. Okay? Now, let's turn our attention to management fees. When it comes to managing your account, think of it this way. You may think that it's not costing you anything or not costing you much by having someone do this for you. But as I said, it will only take 15, maybe 30 minutes a week for you to do this. And I want you to be aware of what you're giving up by not doing it. So here's a chart that I want you to focus on. Now, this chart is based on an average 7% annual return. Okay, 7% annual return over time. Now, if you're starting with 100,000 here, and we move forward 20 years at an average annual return of 7%, with no fees, okay, or low fees, you would grow that account from 100 up to over 350,000. Okay, great return. But let's say you had a 1% fee in there. What kind of an impact would it have? Well, have a look at this. On that same 100,000 over that same 20-year period, you're now saving just a little over 300,000. That's a $50,000 difference, or about 18% less that you would be saving over that time. And if you went to 2%, which is about the average fee these days, that same 100,000 would only be worth slightly over 250,000. That's a difference of $100,000, or about 40% difference. So would it be worth it for you to take control of this and do it yourself, 15, maybe half an hour a week, to look at your positions versus giving up that 100,000 over this 20 years? And for those of you starting with a bigger pool, or having a lot more time here to retirement, the numbers could get staggering. They really could. So when it comes to actually actively managing your account, timing plays a very big role. Again, I will show you easy ways to do this. But what you want your profit and loss curve, your P&L curve, to look like is pretty much a straight line, or more importantly, a stair step. And I'm going to just draw this out on a chart for you. I think it'll be clear for you. Let me just finish the other points on this slide. I'm going to switch to my chart and show you what I'm talking about. What you really want to do is not only focus on the items that you clearly understand, but only jump in on those opportunities when the odds are stacked in your favor. And I'll talk a bit about that as well. But buy and hold, and this is where the risk comes in, having someone else manage your money, someone that isn't very actively managing your account. This is where all the risk is. Buy and hold simply doesn't work. Okay, let me bring up my charting platform and show you exactly why I don't believe it works. Now, this is a chart of the SPYs, the S&P 500, okay, on a monthly time frame. Now, when you're actively managing your retirement account, you want to either look at the weekly or the monthly, preferably the monthly time frame only. It really does smooth out the charts and makes your decisions, or the decisions you should be making, much more predictable. It's much easier to trade off a longer term chart than it is off a daily, or certainly a lot easier than trading off a 15-minute or 5-minute, etc. Now, ignore what you see here. These are this is our Veracity system, and this is our automated platform on Metastock. You can use any system. You don't have to use Veracity or any of our other ones. You can use whatever works for you. I just want to show you a couple things. Number one, that P&L curve that I was talking about. Okay, it'd be nice, obviously, to have a P&L curve that looks like this, constantly making money, going in a straight line up. Great, very difficult to do in most cases. But what you want to do, at a minimum, is have a P&L curve that looks like a stairwell. Okay, something like this. Let me just take a moment to draw this in. And the whole reason for this is that what you really want to avoid are those big drawdowns. In other words, during strong trending markets, it'll be fairly easy for you to grow your account this way. The key becomes, and how do you protect your account when the market rolls over? In other words, if you're giving up all your gains during a market drop, okay, then you're just churning your account back and forth, and you're taking a lot of risk. And the risk is this: same where if a money manager was managing your account, but it wasn't doing so actively, put what he called or she called a diversified portfolio of funds together, put in a drawer and left it. Here's the risk. Imagine you started out back here in 1997, okay, and you were 10 to 15 years away from retirement. And then we get to 2009 here, about 12 years later. Have a look at where we finished off here in the markets, pretty much where we started in 97. So in other words, you could have made big money and then gave it all back, and then made big money and gave it all back. So the timing aspect of this is, when exactly are you retiring? If you're retiring up in here at the end of the spike, then great, you've made a lot of money and you've kept it, and now you're set for retirement. But if you happen to retire sometime around here, you'd be in a lot of trouble with no time to make it back. Okay, I don't think any of you would want that. So, yes, you need a simple system that will help you or tell you when you should get in and when you should get out, and we'll talk about that. That's what the second half of the presentation is for. The real key here is protecting yourself. Once you've made those gains, how do you protect them and avoid these big drawdowns? Okay, very, very crucial. Now, and let's get on to a different point, and that's seasonality. Now, again, if you don't have a pencil and a paper, you might want to jot these down somehow. This is a very interesting side of the market that not many people, even today, I'm surprised at how few people look at this today. Magic of seasonality. You know, there are clear patterns that happen over and over again, month after month, year after year in the markets. Many of them are repeated in the same markets or by the same market. So obviously, if you're trading on technical analysis, you know exactly what I mean by patterns. This is more about performance on an individual level, individual stocks or individual markets, okay? And you really should pay attention, close attention, to trends that repeat themselves, because they can act as a leading indicator for you and can really help you grow your accounts, okay? So you really do want to focus on the monthly time frame, okay? And you want to focus on yearly trends, minimum of 5 years of data. Now, I've got a few gems for you here that I'm going to give you today, but I want you to be able to do this on your own, and I want to show you exactly how easy it is. Now, here's a chart, and this is from a tool that I use, and it's on the stockcharts.com website platform. I'm not affiliated with them in any way. I just like using the tool. It's a seasonality tool, and what this tells you here, if you look at this, this is a graph of MCD, which is McDonald's. Okay. Now, have a look down here, the bar at the bottom, that number 20 that you see just above our logo, that means it's a 20-year period. So over the past 20 years, during the month of November, as you can see here in this big bar, 100% of the time in the month of November, over the past 20 years, McDonald's went up an average of 4.1%. So talk about a leading indicator and a great way. Imagine filling your journal up with stocks like this or trends like this. So all you have to do is mark this in your date, in your calendar. But what you want to do is mark it 2 or 3 weeks before the beginning of November. That way, you know, you don't want to just simply buy on November 1st and sell on November 30th. That's not the right way of doing it. That's not what I'm talking about. You still want to have a system to tell you when it's time to get in and when it's not. Remember, you want to stack the odds in your favor. But knowing that this is going to happen, you pretty much know there's a very, very high probability that you are going to get a long setup in McDonald's, on McDonald's during the month of November. The key is to keep an eye on that chart from a few weeks before and make sure you don't miss that setup. Let me share another one with you. Alta, ULTA. This one over past 10 years in September, during the month of September, 100% of the time is up an average of 18.4%. That's huge. How quickly do you think you can grow a retirement account with trades like that? And again, it's not a matter of being a so-called expert or, you know, spending 30 years like I have, becoming a pro at this. You can do this on your own with a few key items that I'm going to share with you. So here's another one. Facebook. Now, Facebook hasn't been around very long. It's been around 5 years. But for those 5 years, during the month of September, 100% of the time, an average gain of 11.9%. Pretty good. So these are all ones you can walk away with. Mark them in your journal, keep the symbol on your watch list, and when that setup comes up, in the last couple for the month of September, we're very close to September. You should be looking for that buy signal very, very soon on these. Okay? So we can, if there's time, try to look for more of those, but I hope you enjoy those. They're three pretty nice ones. Now, when it comes to diversification, how difficult is it, or what does it mean? How do you handle this? Well, 70-30 split between equities and bonds is pretty much a no-brainer, and that's sort of like what's traditionally been used. Is if you want a portfolio and you're a little younger, can take a little more risk, you go 70% equities, 30% bonds. Now, obviously, these days, going into bonds, not as prosperous as before, or certainly not a great opportunity right now. But the key here is that when you're younger and you can afford more risk because you have more time to retirement, so that if you take a loss, you have a lot more time to make it back, right? You want to go higher on the equities, but the key is always the timing, is when do you go long on equities. Remember that S&P chart I showed you? You don't want to be long during that pullback. You only want to be long when it's trending nicely higher. But as you get older and you build up that retirement account, it becomes more about saving what you've made rather than trying to earn even more. And so the allocation gets reduced. Equities might go down to about 50% or even lower, and they'll do so with high dividend stocks, which are, give you the opportunity to earn additional income. Bonds may stay at 30 or less, but you may go into something that's a little more consistent, like REITs, which are the real estate investment trusts. And I'll show you a few charts of those as well. So change the allocation as you age, okay? That's one of the things. And remember, there's always a bull market somewhere. And now here's 4 key areas that you want to be in on a regular basis to pretty much cover the market. They are equities, crude, gold, and the dollar. If you cover most of those areas with your portfolio, you've pretty much cornered the market, because when one is going up, the other one's going down, and so on. And if you time this properly, you'll do extremely well. So let me bring my charts back here and share a couple of other things with you. Now, it's very, very simple for you to manage your account. I'm gonna share one with you. I'll give you a tip. There's another way to do this, but I'll share one with you. I'm actually going to put on a different chart here, and it really doesn't matter what chart. If we have time, throw out some symbols and we'll look at a few charts for you, okay? Actually, you can put them into your chat box now, and I'll try to get to them as I can. But what you want to do is you want to avoid the flat areas, and you want to be in the trend when it's moving in one direction. Now, one simple thing you do is just use a moving average. When it's moving sideways or consolidating sideways, that moving average will be flat, okay? When it's trending, that moving average will be sloping. So here's a tip, and I'm going to switch this because I believe I have a 20 on here. If you take a 10-period moving average, okay, just a 10-period simple moving average, that's it, and you plot it on there, look how well it mimics price, okay? And look at the amount of time that it spends on one side of that moving average versus others, okay? Again, we as traders tend to overcomplicate things. We are our own worst enemy, and with so much out there, so much information, especially recently with the internet, there's so much out there to look at that we see it as a daunting task and don't take the time to manage our own money effectively when it's extremely simple to do so. From a timing perspective, you throw a 10-period moving average on there, and when it moves above and it's sloping here, you're in during that area. If it crosses back below or flattens out, you get out, okay? Very simple. Now, is there a more effective way of doing this? Yes, there is, and I'll tell you in a minute, but this is as simple as it gets, a 10-period simple moving average. Now, imagine that you buy a stock like Nike, pays a dividend, all right, and you're holding throughout this period, and not only is your stock appreciating, and it's very simple and easy to manage, how much time would it take for you to look at this on a weekend or even at the end of each month when there's a new bar and make that decision? Okay, I would suggest looking at it weekly, but imagine you're in this moving average pointing straightly higher. It's nicely above the moving average. The thing about monthly charts is all those big spikes back and forth from earnings or any other news announcements on the daily charts or those intraday charts, they're gone. They're smoothed out. So you would look at this and say, hey, no reason to sell just yet. We're still above the moving average. No problem. I'll just continue to hold. So it's a quick look at a chart and off you go. Very, very simple. And again, you don't have to use our veracity system here. You can use whatever system is working for you, but it is quite simple. Let's see, are there any charts, any symbols? Let's have a look. Yeah, so let's look at Starbucks or Amazon. Who was it that asked for that? Let me see. Gemini, I believe it is, if I can read it properly. Well, give me 1 second here. Let's look at Starbucks. Again, focus on the monthly. Here's a chart of Starbucks. Did you really want to be in it through here? No, you know, your money would be much better off somewhere else where it can actually earn you something. Moving average is flat, you don't get in it. Now, usually after a big downturn, there's opportunities. And here we are. And look at these. How easy would this have been? Okay? Now, you want to take it a step further. Once you get comfortable with the basics and you want to incorporate options into this, even better. Imagine selling calls at the peaks and then buying them back down here, or just selling calls throughout and earning that extra premium while you also collect dividends. Kind of crazy. Let's look at Amazon here. If we have time, we'll look at a few more. Here's Amazon, okay? And again, basic technical analysis, okay? Doesn't have to be complicated. You come out of a long sideways consolidation like this, what do you want to do? You want to mark the high here, okay? Just draw a trend line. You mark the high. When that high is breached, it's usually the start of that trend. Very simple. You don't have to be a technician. You don't have to be certified. You don't have to, you know, take 10, 20 years of study for this. There's a few key things you can do to manage your money, okay? There's Amazon. Barton was asking for Cisco. Let's look at Cisco. Look at Cisco. There. Now, Cisco had this huge run up here. Remember, 2000, and then the collapse, the bubble, the tech stock. Cream. Since then, what has it done? Flat. When you look at this, why would you even bother with this chart, right? Now, it's starting to move a little here recently, but not a whole lot, okay? So, again, it won't take much for you to flip through a few charts and decide what is a good market to be in and what it is not. ETFs, Forex, and whatever you want works exactly the same way. FXY, let's look at FXY for, I'm sorry about the pronunciation. Sajao, I believe it is. FXY, let's look at FXY, which is the Japanese yen ETF on a monthly basis. Here we are. So it obviously did very well for quite some time, but once it rolled over and dropped below that moving average, and that moving average started sloping lower, it was a no-brainer decision as a short. Now it's clearly turned and it's pointing higher, going higher. So it's not difficult to understand, but there are other methods that you can actually use to judge it. So let's do one more here. AWK from David. Now, I don't believe AWK has a lot of history, but we can also look at a weekly chart. Let's see. Here's AWK on the monthly, and here's the latest signal from our system back here in August of 2015, moved up nicely. But here, look, basic technical analysis. Look back, draw that trend line. Those highs are breached. Is there a slope in the moving average? Yes, there is. And since then, it's been a nice stair step higher. Beautiful move. Okay, so it doesn't have to be very difficult at all. So how can you actually do this yourself? Well, we've put together a great course for you here. And I want to just go over a few of the highlights of this course for you. During this on-demand recording, I teach you 4 different strategies that will not only help you grow your account, but protect it. And I'm going to take the approach both from a fundamental and a technical analysis standpoint, because I know there's some of you out there that truly believe in fundamental analysis. Those of you who have followed me for a while know that I do not, for very specific reasons, but I am a technician and trade solely on technical analysis. But I'm going to give you both in this course. I'm going to teach you a valuation formula that is basically what Warren Buffett type would use in this, but it's very quick to calculate, and I'll share that with you. But then I'm going to give you a technique. There's one indicator that is extremely accurate on that monthly time frame, that it'll tell you clearly when you want to be long, when you want to be short, and when you want to stay away from a market. It's very simple, one simple indicator, and I will share that with you. And I'm also going to share with you some strategies to help you pull in some additional income during these spikes, all right, with options, how to bring in some extra premium, and more importantly, how to protect your account so that your P&L at worst will look like a staircase, not that back and forth that you see on the S&P chart, okay? This is probably the most important part of it, and I'll show you exactly how to protect what you've managed to earn on your own, okay? As a bonus, we're going to give you a membership to our Trading Wins Pro service, but we're going to extend this. We normally give 30 days. We're going to put you all the way out to October 1st. And I just finished about a half hour before I got on here doing this class, The Magic of Ichimoku, for our pro members. We recorded this morning live, and we're going to throw that in for you as well, okay? And if we have time later, I'll tell you a bit more about the pro membership. But the link should be in your chat box. Just click it from there, and all it is $47 here. You can get all of this for just $47. I think I have a few more minutes. I'm going to ask Raul to join us, and he's our coaching coordinator. He's going to help me read off some questions so we can get through as many as we can in the few minutes that we have left, okay?
Vince, thank you. Always a great presentation. I was just overhearing. The tech guys tell me that tradingwins.com/summer also works for this package.
Great.
And I know you and I had been chatting about this earlier, about saying last few days of summer, trading's about to pick up on things. Trading's about to pick up, and this is your little way of saying here's a gift.
Yeah.
Tesla was a request that was made from Sam.
Sure. Let's have a look at Tesla. Love the cars, by the way.
Did you see the new announcement of the supercars now that they're...
Yeah, well, he's promised to deliver the fastest car in the world.
Fastest production car, yeah.
Yes. Now, that little message box that you saw pop up, that's because our veracity system requires a certain amount of data. And on the monthly, we don't have that yet on Tesla. But let's move to a weekly and see what when it shows up. Let me zoom, I'll bring in more data here. And so Tesla, you know, aside from this original spike here, has been very choppy or been trading in a range. Now, certainly there are big ranges, so there's a lot of opportunity for, you know, on the daily time frame or intraday moves, etc. From a retirement account perspective, you don't want to be putting something like this in your portfolio. It's higher risk. You want to stick to the ones that are very smooth, very predictable. Any other requests?
I do have a couple of requests, but I do have questions as well.
Absolutely.
Brian was asking, Vince, is it too late for me to start? I'm 62 years old. I have a small portfolio.
Not at all. This is what I mean. You know, in the ideal world, yes, we would all start saving from the minute we got our first job. But that's not reality. Most people, unfortunately, can't start till much later in life. Now, the fact that you're 62 shouldn't be looked at as a negative. You can start now and make up some ground, and I'll show you how. During this class, like I said, I'm going to give you different strategies that you can employ right away and do it yourself very easily. And with that one indicator that I share with you on a monthly chart, it'll pretty much be a no-brainer. But more importantly, especially for you at your age, I will show you how to protect what you gain, because you cannot afford a drawback. In other words, if you have a gain like this on Tesla back here, then you cannot afford to sit in there through this pullback. Okay, you need to protect yourself, and I'll show you how to do that, not just from a regular pullback, but from any major news announcement that would cause a big gap against you. Okay, I'll show you how to do that, and over time grow your account consistently.
Georgina, I will get Vince to put that offer back up.
Yes.
Since you've spoken with, coached, mentored thousands of students, traders, investors, etc., what's the biggest mistake that you see people making with their retirement planning?
You know, the thing is not managing it, not giving it the attention it deserves. That's right, what I mean. And treating it more like they would a day trading account. Okay? So here, actually, I'll put in here for those of you /summer. You can also get to the link here, tradingwinds.com/summer. It'll get you to this page. But that's the biggest mistake I've seen people make, is treat it like a day trading account and trying to go in and out more often, or totally being scared away from it, overwhelmed, and thinking it's way too difficult for them to do when it's not. Again, in this class, I'm going to show you exactly how to do that, and it won't take any more than 15 to 30 minutes a week for you to monitor.
Anthony says the markets are just too rough right now. Can I still use these strategies in these markets?
Absolutely. It's even more reason to use them during this time. If you look at the monthly charts compared to the dailies, you'll see a big difference in most cases. The monthly hardly been affected by all this back and forth, is where the daily, nowadays, it's hard to find a clean chart. Most of them are messy. So it is extremely, it is a great idea to use it in this type of market for sure.
Jay, Frank, Trang, all three asking what's included as part of the Pro membership.
Oh, so for the Pro membership, there's a number of things. Number one, from Sunday to Thursday every week, 5 times a week, you'll receive a video from me where I recap the markets, highlight trades for our members, not just with our Veracity system, but all our systems. And my favorite part, the live market chats. Twice a week, you get to come into our room, ask me any trading related question you like. We have session 1 coming up Monday evening at 8 p.m. this coming Monday. So you can join us then and ask me any trading related question. My job is to help you become a better trader. So all of that is included with that. And all the sessions are recorded. So twice a week you'll get the recordings of the live market chats plus the 5 videos. And now, just like this Magic of Ichimoku class, every month we have a course that we provide for our Pro members that we normally sell for $197, but it's free for the Pro members. So you will get this one, and then becoming a member and being with us until October 1st, you'll get the next one as well.
All right. I've got Teresa saying, can I join the market chat on Monday? Absolutely, Teresa. Once you sign up, just send us an email, info@tradingwinds.com. Be happy to have you join that. You know, I really do see you enjoying those sessions. I'm privileged enough to be on those sessions with you, just chatting with folks that say, wow, I didn't see that know, with the cloud, with this, with that.
Because the group of Pro members we have all have a different background and different levels of experience, and some of the questions that come up are a great learning opportunity for everybody. So they're great sessions.
Okay, we've got a minute to go. Can you recap the offer and how do folks get it?
Sure. So you should have a link in the chat box that you can just click on. If not, you can go to tradingwinds.com/summer. And this is our retirement strategies course, where during it I'll teach you the 4 strategies that you can use to grow and protect your account. I'll share with you that fundamental analysis type valuation formula that you can use to pick out some of the most solid companies out there to invest in. And I will show you, once you do get into a trade, how to take advantage of it and really generate even more income than just by the stock appreciating. I will show you with option strategies what you can do. I'll share that one indicator that is phenomenal on a monthly time frame. That alone is worth way more than what we're asking for this. And more importantly, I'll show you how to protect your gains. As a bonus, as I mentioned, a Pro membership up until October 1st, and a copy of the Magic of Ichimoku course, which we just recorded about a half hour ago. Okay? All of that for $47, tradingwins.com/summer, or click on it from your link. I think I'm out of time, so thank you very much, everybody. Great to be here with you again. Hopefully we can do this soon with that. And a big thank you, by the way, to Investor Inspiration, everyone there.